All right, let's jump right in. Today, we're doing a deep dive into one of the most common and, frankly, most expensive tax traps that families run into when paying for college. I'm talking about the sudden, shocking disappearance of the American Opportunity Tax Credit, the AOTC. We're going to go way beyond the basics and get into the specific IRS rules that cause all this confusion. You know, it's a story that plays out every single year. A family is cruising along, they're planning on that final $2,500 credit to help with that last big tuition bill. Then they go to file their taxes, and poof, the software just says, ineligible. It's a huge financial shock, and it leaves them scrambling, asking, wait, what just happened? What did we miss? Well, what they missed is something we call the super senior trap. And the very first thing you have to understand about this is that it's not a glitch. It's not a mistake in the software. It's actually a deliberate feature of the U.S. tax code designed to limit the credit. The trap gets sprung by a set of really complex interlocking rules that you absolutely have to understand before you get to that final year. So what's the cause? What's the mechanism here? The root of this whole problem is that the AOTC is governed by two totally separate limitations. The best way to think about it is like two competing clocks, ticking away at the same time. The second that either one of those clocks runs out, your eligibility is gone for good. Okay, here's where we get into the technical details. You can see the two clocks right here side by side. On one hand, you've got the claim clock. This is just a simple counter, and it's governed by Internal Revenue Code Section 25A-5. On the other hand, you have the academic clock, which measures the student's progress, and that's governed by Section 25A-5. Now, the absolute biggest mistake people make is thinking these two clocks are in sync. They are not. They run totally independently, and either one of them can knock you out of the credit. Let's start with the easy one, the claim clock. This is just pure, simple math. You, or anyone else for that matter, can only claim the AOTC for a specific student for 4 tax years. That's it, period. It doesn't matter if the student took a year off or is only a sophomore academically. Once 4 tax returns have been filed claiming that credit for that student, this clock has run out. It is a hard cap. Okay, so that brings us to the much trickier clock, the one that really trips people up. That's the academic clock. The law says the credit is disallowed once a student has, and I'm quoting here, completed the first 4 years of post-secondary education. But what on earth does that actually mean? Is that for calendar years? Is it for academic years? It's nowhere near as simple as it sounds. So the whole key here is to figure out how the IRS defines this term. Let's really break down what it means to complete 4 years from a tax perspective, because it's probably not what you think. First things first, forget about calendar years. The IRS could not care less how long a student has been physically on campus. What they care about is the student's academic standing, and this is the important part, as defined by the university. The IRS basically outsources this decision to the school. So if the university says the student has enough credits to be considered a senior, or even a post-baccalaureate student, the academic clock might have already expired, even if they haven't walked across the stage to get their diploma. Oh, and here's a huge red flag. Look at Form 1098-T. If Box 9, the graduate student box, is checked, it's pretty much game over for the AOCT. So for most universities, what's the benchmark? What does completion really mean? It usually comes down to the number of credits you need for a bachelor's degree. And for a lot of schools, that magic number is 120. If that student's transcript shows they've been awarded 120 credits, the IRS is almost certainly going to consider them to have completed 4 years of study. Now, this immediately creates a problem, especially for those high-achieving students, right? What if a student shows up on day 1 with a full year's worth of AP credits? On paper, they might hit that 120 credit mark way early, maybe by the end of their 3rd calendar year. So does that mean their academic clock just runs out early? Does that make them ineligible for the AOTC in their actual senior year? And right here, we find a fantastic little safe harbor built directly into the regulations. The Treasury Department is crystal clear on this. For the purposes of the AOTC, you are to disregard any academic credit awarded solely on the basis of the student's performance on proficiency examinations. This means AT credits, IB credits, CLEP credits, none of them count towards that academic clock. They will not disqualify you early. But, and this is a really, really important but, we have to draw a line in the sand here. That exception only applies to credits you get from taking a test. It does not apply to dual enrollment credits. You know, the ones you earn from taking actual college classes while you're still in high school. Those credits absolutely do count, and they will accelerate the academic clock, potentially springing the trap a full year earlier than you expected. Okay, So we have thoroughly dissected the problem. Now let's talk about solutions. The good news is the tax code itself actually gives you the tools you need to get around this trap. You just have to know where to find them. For most people, the real culprit isn't even the academic clock. It's the claim clock, colliding with the simple reality of the calendar. Just look at this timeline. A normal standard 4-year degree, well, it spans 5 separate tax years. It starts in the fall of year 1 and wraps up in the spring of year 5. And here's the unavoidable consequence of that. If you claim the AOTC for the first 4 tax years, that's year 1, year 2, year 3, and year 4 on the calendar. You've used up all 4 of your claims. Your claim clock is exhausted. So when that final tuition bill for the spring semester shows up in January of year 5, you have 0 eligibility left. This is where we find our secret weapon, and it comes directly from the code. It's called the Prepayment Rule, and you can find it in Treasury Regulation section 1.25A-5E. This rule is incredibly powerful. It basically says you can pay for next year's spring semester this year, and for tax purposes, you can treat that payment as if it were a current year expense. And that leads us to the December pay-ahead strategy. It's really straightforward. Here's how you do it. In December of the student's 4th tax year, that's senior fall, you'll get the bill for the final spring semester. You need to pay that entire bill before December 31st. Because of the prepayment rule, those expenses can now be included on your year 4 tax return. This lets you essentially squish both senior year semesters onto one tax return, and you get to maximize your 4th and final AOTC claim to cover everything. But what if you can't use that strategy? Or what if you're watching this and the trap has already sprung? Well, there is a backup plan. It's a safety net, but it's a safety net with some pretty big holes in it. Let's talk about the Lifetime Learning Credit. Once your AOTC eligibility is gone for any reason, the only other education credit on the table is the Lifetime Learning Credit, or LLC. It is so important to understand that this is not a one-for-one swap. It is, in every single way that matters, a structural downgrade in terms of tax benefits. This chart really lays out the differences starkly. The AOTC is worth up to $2,500 per student, and a chunk of it is even refundable, meaning you can get money back even if you don't owe any tax. The LLC, on the other hand, is capped at $2,000 per tax return, not per student, and it's completely non-refundable. The math is also way less generous. Sure, the LLC is available for unlimited years, but that drop in value, and especially that per return limit, that's what really hurts families. This bar chart really shows you the damage that per return limit can do. Just imagine a family with triplets, all in their 5th and final year. If they were eligible for the AOTC, they could get up to $7,500 in credits, $2,500 for each kid. But with the LLC, their total credit for all 3 students is capped at just $2,000. That's a $5,500 loss in tax benefits in a single year. It's brutal. So let's wrap this all up and hit the key takeaways. Number 1, always remember the 2 clocks, the 4-year claim limit and the academic completion rule. Number 2, take a deep breath about those AP and IB credits. They don't count against you here. Number 3, your most powerful tool is the December pay-ahead strategy, which is made possible by Treasury Regulation 1.25A-5E. And finally, number 4, if you get pushed onto the LLC, you have to understand its per-return limitation and plan your budget for that final semester accordingly. And that really just leaves us with one final big-picture question. This stuff isn't just about filling out a form in April. It's about strategic planning that starts years earlier. So ask yourself, is your student's academic plan aligned with your family's tax plan? Because making sure those 2 things are in sync is the absolute key to making sure you never fall into the super senior trap.